Hello, Shreyash ji.
Good morning, everyone.
Good morning, Mr. Shreyash.
Good morning. Good morning.
आपकी आवाज कम आ रही है.
Hello, am I audible?
Yeah.
Is it better?
Yeah, it's better.
Voice is on a lower pitch. Can you adjust?
Yeah, अभी ठीक है. I think अभी ठीक है.
Okay, let me know if it's not audible.
I think it's audible now. So good morning, everybody. On behalf of Alaknanda and Greater Class CPE Study Circle of NIRC of the Institute of Chartered Accountants of India, I have the pleasure of welcoming Advocate Shreyash Shah ji to take today's session on key takeaways from Union Budget 2022. Let me introduce Mr. Shah. Shreyash Shah is a counsel at Bombay High Court. He is a qualified advocate with over 8 years of robust experience and secured merit in academics. Shreyash specializes in litigation, especially taxation and corporate laws, and has been involved in a number of high-stake litigation. He appears regularly before the High Court, tribunals, and Commissioner Appeals. He has briefed and appeared along with senior counsels before the Supreme Court. His practice also includes advisory on complex tax issues ranging across various sectors. We welcome you, Mr. Shah, and look forward to your deliberations.
Thank you, Mr. Pranav, and good morning to everyone from Alaknanda and GK Study Circle. So the topic that I'm giving is key takeaways of the Union Budget. My first initial comment on this particular budget is if everybody has looked at the finance bill, one may notice that in this particular budget, there is three particular initiating years, which is 1st April 2021, then second is 1st April 2022, and third is 1st April 2023, which means that most of the provisions that have been brought in are impacting the present financial year. So everyone needs to bear this in mind, that few provisions while you are reading the finance bill could apply you to this particular financial year or even for the previous year, which is FY 1920 or 2021. I just request somebody to project the finance bill so everyone will have the benefit while I'm referring to the sections.
Senika is doing it. Senika.
Yes, sir.
Yeah, thank you. Yeah. So if everyone has understood the particular impact of the provisions, then I'll go to the next point, which is this particular finance bill has, like every other budget, has impacted the widening of tax base. In fact, if you see the latest report by IIM on cryptocurrency and drawing some, you may call it as, hello, yeah, drawing some inspiration from the IIM report, the CBDT has introduced a crypto taxation. This is only my initial comments. And I would like to state that government has rightly done so, but there are certain criticisms from the market where they have already put it at a highest tax rate. So that is something which has to be borne in mind. And it's a welcome move by the government, no doubt about it, because government should also have fair share of its own taxes. It shouldn't be a situation where you have all the horses that have bolted the door and government is losing the share of taxes. So this particular move I would rate as a welcome move. Second is I would say that there's section 14A which has been brought in, and this 14A is something which was already settled by Supreme Court and various other decisions of the High Court, but now this particular amendment has brought in a situation where you are pulling up a dead person from the grave. So I see this we'll come to this particular section in detail. These are my initial comments. And next is something which is related to faceless. Everybody, whoever is practicing out here, would have certain situations where there was no opportunity given, or there was very short time given, and you had to knock the doors of the High Court. And now the changes that have been brought in the faceless, to some extent, you can call it as a aligning with the decisions of the High Court, as well as they have given certain clear indications how the assessment has to be carried out in the faceless manner. So with this, I will first start my detailed analysis on the first section, which is 115 BBD. This refers to the rationalization of dividend provisions, and it is a situation where the foreign company has declared a dividend to an Indian company, and that particular Indian company holds more than 26%. And more so, this particular provision which has been brought in 115 BBD, it is to make parity with Indian companies which are paying dividends. If everyone remembers, the finance budget of last year had removed the Union Budget 2020 had removed the taxation on dividends, which was a very bold move by the government, because previously it was not taxable in the hands of the shareholders. Now it's taxable in the hands of shareholders. So in order to make even parity with the Indian companies, this particular provision has been done away, wherein the rate was 15%. Previously, whenever any foreign company pays a dividend to Indian company, it was taxed at straight away 15% of rate, but now it will be taxed at the normal rate. And one situation, if everybody knows, that companies like TCS, Infosys, these two companies are having major chunk of offshore work, and they also have subsidiaries outside India. So Infosys and TCS will be hugely or adversely impacted by this particular provision. Moving on to the next provision, which is a very important provision related to educational cess. It is section 48 clause 2. This is a disallowance which is you can come to section 40A, 40 bracket A 2. You want me to tell you the page number?
Yes, sir, please. One.
Yeah, just a minute.
Go straight to section 40 now from the
Page
index.
number 38 of the PDF. 38 of the PDF. Just come to. You can type 38. No, I'm saying 38 of the PDF. Yeah.
टॉप में ठीक कर दो ना 38.
Yeah, just go down.
Yes, sir.
Okay. So coming on to this particular provision, it refers to the cess which was allowed by certain high courts as a deduction or expenditure, and the cess, as per the income tax department, is something which is known as an additional surcharge. So according to department, this is not a deductible expenditure, and thus it has to be disallowed under 48(2), because the very nature of the cess is only to bring some initiatives of the government, and which is why you are collecting the cess. Now I'll give you the example of certain decisions of the Bombay High Court and Rajasthan High Court. You may note down. It is Sesha Goa 423 ITR 426 and Chambal Fertilizer 107 taxman.com 484. This is Rajasthan High Court. So relying on the circular of in 1967, the High Courts held that this educational cess is an allowable deduction and cannot be disallowed by the department under 48(2). So contrary to these decisions of High Court, a bench of tribunal of Kolkata, in the case of Kanoria Chemicals, the ITA number is 2184 of 2018. The Kolkata gave a very interesting view that cess is a form of additional surcharge, which means that additional surcharge, when it was introduced in Finance Act 2004, at that point in time, it was the intent of the government or the legislature to always consider the cess as an additional surcharge. And relying on the decision of Supreme Court, ITAT said, and the decision is Srinivasan. It's a 1970 decision of 83 ITR 346. So these decisions of High Court was distinguished, you may call it as, by the Kolkata bench. And also the similar view was held by Chandigarh ITAT in the case of GSK. Now the amendment, when we look at, is clearly saying that this is a retrospective amendment from 1st April 2005. So whoever has taken the benefit of this particular provision, because I have been appearing in tribunals and High Court, so we have taken this as a additional ground, because everyone would know that relying on the decision of NTPC, you can even take a legal ground at any point of time. So in fact, we have taken this additional ground and got reliefs from the ITAT. Now the situation could turn around as differently, because before High Court, this would certainly be challenged. And since it's a retrospective amendment, you could face a problem. But the department has clearly said in the memorandum that the decisions of High Court are per inquirium, because they never looked at the apex court decision of Srinivasan, which clearly said that cess is a form of additional surcharge. And many tribunal decisions because of this will get certainly impacted. Now, this is what my view is, that the government in 2015, when late Shri Arun Jaitley had presented the finance bill, he had clearly said that we will not be introducing any retrospective amendments. And it goes also against the grain of Supreme Court's ratio in the case of Sidco and Vatika Township, that whenever any substantive amendment is brought in, you have to apply it prospectively. So it will be a problem, and there could be a litigative points by various, as in you can say it, assessee as well as department will certainly be hell-bent on getting this particular argument in their favor. So and importantly, the government at least should have clarified. Let's take, for example, by virtue of this ITAT order, I had taken a benefit, or the High Court order, I had taken a benefit, and in my books of accounts, I had claimed it as an expense. And take a situation where department makes an addition by taking back the cess. And in that case, the government at least should have clarified that no penalty should have been levied. So, and because penalty becomes an important outcome of the assessment order, so I feel that the government should clarify at least on this particular point of penalty being not levied in situations where you reverse this particular case. So till now, anybody has questions, then we'll move to the next point.
Shreyash, I would just like to understand,
Yeah.
like this cess and this particular matter, 14A matter, because in both the cases they have done their with retrospective effect. Do you feel that all the assessments will be opened and the taxes recovered?
No, that's a very interesting question now. So we will have to look at the reopening provisions. I'll come to the reopening provisions in detail, but going by the nature, in the way the section 149 has now been amended. If you look at section 149, they have also said by virtue of a order of court or tribunal. So now there is a debate which is going between a lot of practitioners whether it could mean that whenever any decision is given in favor of assessee, does that imply that it could lead to reopening of cases? My view is that it could not, until and unless the court or tribunal has specifically made a direction or gave a direction to the department that yes, you can reopen, then it could lead to a reopening case. Otherwise, I don't see a problem that there could be a reopening. I hope I have answered your question.
And moreover, in this is the amendment on the litigation management under section 159, the government has shown the intention that they do not want to harass the SSE. So
yes, so that 158 AB.
Yes, litigation management.
Yes. So, as in that is a altogether separate point. I see where you are hinting at, but it needs to be settled by Supreme Court now. So until and unless Supreme Court doesn't decide, everything is status quo. And if you are based in Bombay or Rajasthan, you can certainly take benefit of these High Court decisions till now. But
the penalty provisions is said I don't think can be attractive because you have made the amendment now. So how can you attract the penalty from a backdate? You can at best charge the tax and the interest, not the penalty.
yes, so
exactly. Where was the SSE on the wrong foot? SSE was always on the right foot. You have made amendment now, so it is so how can you penalize the SSE for the penalty? There was no concealment. There was no bad intention.
So exactly, I agree with your point, but this is what many views are coming, which is also pertinent to note, because you will have a situation. So it is better to be prepared. I agree with your point that it is not a case of concealment. It is absolutely applying the law and the principle. And that is going to be your defense, I would say, whenever any case comes up. But you need to be prepared. Being a devil's advocate, you need to be also looking at the what department could be saying. So that is why certain clarification has to be given on penalty to safeguard every assessee.
So would you advise the clients to file a caveat?
As in, you mean to say after a ITAT order?
Yeah, after this bill is passed, immediately a caveat should be filed so that the department does not take a retrospective view and impose penalty.
No, I am understanding it right. Are you saying that you need to file a caveat before the High Court?
Yes.
Yes, so certainly you should file a caveat against the entire appeal, I would say.
Okay.
Yeah, any other questions?
No, thank you.
Okay, so now let's come to the next provision, which is also, which I said at the initiating point, that this is a provision which is pulling up a dead person from the grave, and section 14A. So everyone would know that section 14A is only related to exempt income and the disallowance which is related to the expenditure incurred on account of exempt income. And this particular issue was settled by Supreme Court in series of decisions. To name a few, one is Wolford, 326 ITR 1, Godrej and Boyce, 394 ITR 449, and famous decision of Maxop, 402 ITR 640. So these decisions clearly said that until unless there is no exempt income, you cannot disallow any expenditure. And more so, the Delhi High Court in the case of Hulshim in 272 CTR 282 has clearly said the sine qua non for disallowance under 14A is to have existence of exempt income. And this particular judgment had also interpreted the CBDT circular of 2014, wherein the CBDT tried to clarify by saying that even if there is no exempt income, still 14A will get triggered. But now, since the circular has been set aside, by various high courts, you can see the amendment being brought into the statute book, which now reads as, you can read on this particular screen, which is there, is section 14A shall apply and always deemed to have applied in a case where exempt income has not accrued or arisen or has not been received relevant to an assessment year, which means that even if it is not accrued or arisen or not even received, still 14A will be applicable. And after looking at this particular explanation, you can say that this is a substantive amendment. And when you call a particular amendment as substantive amendment, you need to bear in mind with ratios laid down by Supreme Court in various judgments, which I previously mentioned as well, Vatika Township and Sitco Forex, which is 279 ITR 310. And they have clearly, these decisions have clearly said that the impact cannot be retrospective, it has to be prospective. So when you look at these decisions, you will clearly say that merely because a clarifying explanation by using the words for the removal of doubts is inserted, it does not make it retrospective, it has to be prospective. So once again, I see a spate of litigations being coming up on this particular issue. And important point one may see is dividend has now become taxable in the hands of shareholders. So major chunk of these exempt income in any person's books of accounts would be dividend income, because dividend income from the investments is was not taxable previously. And one may still ponder that whether this section still has any teeth. I say that you don't have much impact, but yes, there are chances. In fact, when you look at the amendment under 147, 148 and 149, you may then think that when the government has extended the 149 section to even include expenses in respect of transaction or entries of books of accounts, this could certainly lead to reopening of cases. So I foresee that there will be a lot of litigation arising on account of 14A now. Moving on to the next section, it is related to section 37. This is a miscellaneous section where you get the expenses and the deductions. But there is you can see that there is a new explanation inserted, which is explanation 3. I will take an example of to explain you this particular amendment. If everyone remembers that there was a litigation going around the freebies which were provided by pharma companies. So the pharma companies that provided freebies to the medical practitioners or doctors, the department in a circular of 5/2012, they said that as per the Code of Ethics of Medical Council of India MCI guidelines, it is not admissible as a allowable expenditure. However, various ITAT decisions have said that fine, these guidelines apply to practitioners, but who is the person who's giving these freebies? It is pharma companies who's giving the freebies, which means that they are not bound by these guidelines, and thus 37(1) does not get impacted just because of a guidelines given by Medical Council of India to practitioners. It was only applicable to the pharma companies. And when you now look at the explanation, you may see that the disallowance is on account of expenditure incurred by assessee for any purpose which is an offense or prohibited by law. Now, this is a very vague term that is used by the government, because once again a series of litigations will be arising. Let's take a practical example where you compound an offense under FEMA or any other law. Will that amount to admission of offense, yes, it could amount to admission of offense, and thus this is not going to be admissible. But take a opposite scenario where you settle a particular dispute. Whenever any person is settling a dispute, he is not admitting that he has committed that offense. You may see in IPR cases where patent infringement happens between private parties. I'm emphasizing on private parties is because the dispute is only arising between private parties, and thus it cannot be even construed as an offense. So settlement is also not an offense. Same is a case of class action suits. If one remembers the Satyam case, where the class action suits were filed in US, and these suits were settled by Satyam, so that cannot be construed as an offense. So I can still claim that compensation that I've paid by virtue of settlement or class action suits, I will still claim that as an expenditure under 37. And as I said, that this is going to give a lot of litigations, which will certainly come in the coming few assessment years. Last point that I'll make on this particular section is settlement considered as plea bargaining? There is a concept under Indian Penal Code, you may say criminal law, of plea bargaining. Whether settlement can be construed as plea bargaining, one certainly will need to look at, and I don't know whether our tribunals will be able to or are they the right forum to interpret this particular question of law, whether settlement could lead to plea bargaining or even admission of guilt. So in fact, one may also find that the commissioner appeals or even tribunal could call for records of your cases which are pending in competition law or in under IPR. Yeah, so on these two sections, anybody has questions?
No, sir.
Okay, let's move on. So the next section is 43B. This is a interesting section which relates to disallowance of interest on account of loan or borrowing which is taken from financial institutions and banks and NBFCs. So what happens at times is any person who has taken a loan, the interest is unpaid or remains unpaid for a number of years. And after certain years, this particular interest is converted into debentures or loan or borrowing. And what many practitioners used to take a stand that this amounts to payment, which is constructive in nature, and thus it is known as a constructive payment. And what has happened is the Supreme Court in the case of Aqua Technologies 436 ITR 582, they have held that this particular conversion of interest into debentures or loan would amount to actual discharge of the liability, and thus it is allowable as a deduction and cannot be disallowed under 43B. However, this amendment, which has been brought in by way of an explanation, is now saying that whenever you are deferring a liability, which is in the form of interest, to a future date, that shall not be regarded as the actual payment and cannot be claimed as deduction under 43B. So now let's take a practical scenario. If anyone has experienced such unpaid interest and loans or negotiated with bankers in today's time are ready to settle these unpaid interest by way of taking equity or even taking debentures, and they are fine with this. So this particular provision I see as a dampener for insofar as the settlement of liabilities is concerned, and thus I don't know why the lawmakers have decided to bring in this particular provision when the entire banking industry or financial institutions are ready to convert the unpaid interest into loans. So this is going to get a lot of criticism from every sector, because taking loans is a normal course of business for functioning of your daily business projects. Yeah, so next is a very interesting introduction. Everyone would know about the cryptocurrency fire which is going on, and the cryptocurrency taxation which is brought in by virtue of section 115 BBH. Before I go to this particular section, I will give you some statistics. That is, the present market cap of the cryptocurrency is $1.66 trillion, and of which around $710 billion is the market cap of Bitcoin. And in India, the largest crypto exchange is WazirX. And as reported, the annual trade of this particular platform, WazirX, in FY 2021 was $43 billion. So the crypto is gaining momentum and it is here to stay. But what government has smartly done is they have still not given their indication whether they are legalizing cryptocurrency or they are banning cryptocurrency. They have put this under the bracket of the highest tax rate, which means you are as equivalent as doing any illegal activities, because smuggling or even horse racing or a game of chance is taxed at the same rate. And some people may relate this to stock market, because whenever any exchange is there, though it is unregulated, there will be many number of stocks which are good stocks, and some are penny stocks or something which are not even there. So similarly, there are good cryptos which are there in terms of like Bitcoin, Ethereum. I've practically done these things, so that's why I'm just explaining the participants. So you may see that there is a value behind every particular Bitcoin or a crypto. So you may say that there are bad coins also which are not at all advisable to invest, but yes, there is a value behind this particular virtual digital asset. Now let's come to the important aspect of 115 BBH. The section clearly says that this particular transfer of virtual digital asset will be taxed at the rate of 30%. They have also clarified that there will be no deduction of expenditure allowed. And they have clarified two more things, which is there will be no set off of any loss against any income arising from transfer of VDA, and there will be no set off of any loss arising from transfer of VDA against any income under any provision. Now, when you look at this particular subsection 2, clearly the clause B, they have, if you interpret it properly, they have made a carve out, or this could be a interpretation issue, wherein they are still keeping open that, let's take for example, if I traded Bitcoins where I gained 10,000 rupees, and I traded Ethereum where I got a loss of 8,000 rupees. If you take the section in its spirit and what the letter is saying, then I will say that I am still allowed to set off that loss against my gains, because this is falling within this particular provision. The clause B only says that you cannot set off the transfer of virtual asset where there is a loss against any other provision. Means they have still kept the window of setting off the losses interstate of the transfer of virtual digital assets. So this is one point which will be clarified or maybe plugged by the government in coming times. But till the time they don't do it, you are you are free to take this interpretation. The definition is there in section 247A, where they have kept the meaning of virtual digital asset as a very wide term. And I see that this could lead to a lot of interpretive issues, because in one of our discussions, we also discuss whether the frequent flyer miles that are received by the passengers as loyalty points, could they also be termed as digital assets whenever you redeem those? Because see, transfer is a very wide word. Transfer also includes redemption. So, but practically looking at the definition, it uses the word cryptographic means. So it needs to be interpreted whether these frequent flyer miles or cashback points are accrued on account of cryptographic means. My view is that it is certainly not, and thus we cannot stretch that to that extent. But yes, there will be certain questions coming on this part as well. The next point related to this virtual digital asset is the TDS. So TDS is going to be a big question or a monster, wherein they have asked, they have just said that TDS at the rate of 1% is to be deducted by the person who is the payer and who is responsible, and he is responsible for deduction of the TDS. But take examples of WazirX, where the WazirX is just a marketplace where they make the buyers and seller meet. So whenever you meet a buyer or seller, whether that buyer will have to deduct TDS, that is a question, because this is going to be a big question, and more so the TDS, whether exchanges or the person trading is the person responsible for deducting the TDS. Another interesting issue that we have discussed is there could be a situation where you are buying Ethereum against Bitcoin. So whether on that account is TDS to be deducted or not, that is also one question which will be coming up. And certainly I see that the CBDT will be coming out with a lot of circulars in order to explain this taxability of virtual digital assets in the coming times. So before I move to the next provision, anybody has questions?
Yes, sir.
Yeah.
So I have one question. If there is a case wherein an assessee has offered his income from transfer of virtual taxes digital asset to under the head capital gains, and as of now, there is no notice or intimate demand from the department. So does he need to revise his income offered here, or he can move on with that?
Yeah. So
Stand
this
as
is a
a-
nice question. So basically, let me clarify. This particular provision is applicable from AY next as in financial year. So till 31st March, you need not revise any return. Whatever you have offered, you can offer under capital gains, or even you
Okay.
can offer under 68.
60.
Because yeah, so IFOS is something which is going to be also impacted on account of this.
Okay. And sir, one more question. If the total income is not exceeding the maximum, the minimum amount which it is to be taxed, the exempt, it is below the slab rate. In that case, also, if the income is solely from virtual digital asset, it needs to be taxes to be submitted for that.
No,
I mean,
no,
no.
nothing.
In that case, nothing.
No. It's just like how you
For normal, that.
yes, how you have capital gains arising on transfer of shares,
Okay.
trading of shares. It's the same thing. So till the time you don't exceed your exemption limit, there is no worry. Yeah.
Okay. Thank you, sir.
So we move to the next section, which is section 68. And if everyone has noticed that section 68 till date used to be applicable in relation to source only for share capital, share premium, and share application money. So now the finance bill has proposed to amend this particular provision to even include loans and borrowings. So you need to even declare the source whenever you take a loan or a borrowing. Otherwise, whenever the tax officer is not satisfied with the explanation that you have given, he will deem it to be taxable under 68. And this particular point, which is the amendment that is overturning the decisions of various high courts. I'll name a judgment of Bombay High Court in the case of Gagandeep, wherein it's 394 ITR 680, wherein they had clearly explained that source of source in terms of credit, except for share capital, is not needed at all. So this judgment is now overruled and the amendment will take place. But if you see it practically, let's take for example, if a person goes to a money lender and he asks for 1 crore of loan, and he also asks the lender to give him the books of accounts, P&L, balance sheet, will that lender be willing to give him the loan? He will just shoo him away. He will say, I'm not wanting to give any loan to you because you are asking too many things, which is this is a private information. I cannot share for a mere lending of 1 crore my books of accounts and everything. So this practically, I don't see how it's going to be applicable. But yes, in so when you take a loan from a bank, are you going to take all these things? That's another question. So yes, there is going to be an uncertainty on applicability of this particular provision. The next section is section 79.
Shreyash ji, I would like to ask whether the 68 is restricted to borrowings only or all kinds of credits?
All kinds of credits, loans, borrowings. Just read the come to the section.
So if there is an entry, credit entry for purchase.
Yes.
Will you again?
So I'll answer your question in a further better way. If the allegation of the department is that I have taken a accommodation entry, okay, and I have taken that by way of a loan, but if I repay the loan, how is that entry as accommodation entry? In share capital, everybody knows how it's done. So, but in loan, when you repay that loan, is it still going to be an accommodation entry? I don't see it practicable at all. So, have I answered your question?
No, I was just wondering whether it is only the loan entries or borrowings, other credits. There are many credits.
Yes, it will.
My all creditors are, you can keep on questioning.
Just read. I'll read the provision. Provided that whether sum so credited consists of loan or borrowing or any such amount by whatever name called, any explanation offered by such assessee shall be deemed to be not satisfactory. So they are covering everything.
Yeah, but by when they are using the word such, which is attached to the loan or borrowing, that means the entry should be of such nature only. Purchase, you cannot extend it to the purchases.
No. So they are saying where the sum so credited, So you need to apply the principles of ejusdem generis, where you say that this is in the nature of a borrowing or a loan or a credit. So the important word over here is a credit of such amount. Yes, I agree. It is going to be an interpretative issue.
Hello. Okay. Yes.
So let's move to the next section, section 79A. This section is a very consequential section because you may see that whenever any set off is whenever you have any brought forward loss, and at the time of search under 132 or requisition under 133A or even survey under 132A, there is any undisclosed income found, and people generally say that fine, I will set off it against my loss. So this particular measure has been plugged by the finance bill, and I see that it is done in the right manner. Thus, because whenever the intention is to tax the undisclosed income at the highest rate, it should be done, and there should be no set off or any loss arising. So yes, it's a right section which they have done. Second is now section 172A. So this is a section where any amalgamation or merger is happening in the midst of any assessment, and at the time of the assessment there is NCLT proceedings going on, and you intimate the or you get the order of the NCLT on let's say 1st of April, and the order of the AO is passed on 2nd of May, and you intimate this NCLT order only on July 1st. So what has happened is your intimation which has happened at the start that the hearing has started and all is not going to be relevant at all, because I have practically appeared in this particular cases. What we have tried to do is that we have intimated to the AO about the merger or amalgamation happening, and this particular amalgamation in the midst is completed, and the AO passes the order, but in the name of the predecessor entity and not in the name of the successor entity. So we have been taking this case that whenever you pass a order in the name of the predecessor entity, he is non-existent, and thus this order is non-est and bad in law. And this issue was settled by Supreme Court in the case of Maruti Suzuki, 416 ITR 613, and on this basis several ITAT decisions have been given in favor of the taxpayers whenever any order is passed in the name of a predecessor entity is considered as a non-existent entity, and thus they have tried to conclude this particular issue by saying that the intimation by way of the order has to be received by the principal commissioner, and if the principal commissioner receives the order after the AO has passed, then you cannot call that you have intimated to the department. Thus, this is diluting the principles of the Supreme Court. The next provision is interesting provision relating to the divestment of the PSU, section 79. Recently, if everybody knows that Tata's took over Air India, and Air India, as it is in the present state, it has a lot of losses. So this particular provision has been made to facilitate the strategic divestment, which is made by the PSUs, and thus carry forward of losses is permitted by the successor entity. The next provision is section 115 BAB. This provision was inserted in October 2019. Yeah, can you share the screen?
Yeah, I think there is some connectivity issue with Chanika. Let me present the finance bill.
Okay, fine.
Sir, my screen is visible. Hello.
Let it come. Yeah, now it's visible. Yes, thank you. So we are at 115 BAB. So as I was saying, this provision was inserted in October 2019 to give benefit or incentivize companies who are going to be in the nature of manufacturing companies. And the rationale to give was that they should have sufficient time, but since COVID has come in for the last 2 years, many manufacturing companies have not been able to utilize this particular provision to its best of the ability, and that is why they have brought in a sunset clause which is extending now to 31st March 2024. So this is only a extension of the sunset clause, but yes, it is going to give a confidence to the manufacturing companies. The next provision is very important, which everybody would like to know, is 139.8A, the updated return that was announced by the finance minister in her budget speech. So before we go to 139.8A, let's stick to the basic principles which are under 139.1 about original return being filed, then 139.4 which is your belated return, 139.5 which is your revised return, and 139.9 which is return curing your defective return. So these 4 provisions which are there in the statute book right now, and the intention or specified by the finance minister in her budget speech is to give ability to taxpayers to modify their returns, because when you had filed the return this year, you would have seen some new thing which is known as AIS, and this is a 360-degree chart of the entire transactions that has evolved by in an assessee's case, and thus they are now using the AI and everything to get information and data by virtue of which they could inform you that look, you are going wrong and thus you have to pay tax. So if you have not disclosed anything, then the section 139.8A has given the ability to pay to file the return and pay additional tax, and that additional tax is under section 140B. The time limit that is given under this provision is 24 months from the end of the relevant assessment year. So before I go to explain you how it is impracticable, I'll tell you what are the exclusions that they have said. Meaning when you cannot file an updated return. You cannot file an updated return in a situation where there is a search case, where there is already a updated return filed. Then you have a assessment which is pending and reassessment proceeding is pending. So this is going to be a very important point. The next is AO has prior information about the data that you are going to file in the updated return, and it relates to activities under smuggling law, Benami, PMLA, and there is a prosecution which is launched, or there is a case where there is exchange of information under double taxation avoidance agreements. So these cases are excluded and you are not eligible to file an updated return. Now coming to the next section, which is 140B, related to this provision itself, where you have to pay the additional tax before you file the return under 139.8A. The section says that you have to pay 25% of tax if the updated return is filed after the expiry of 139.4 or 139.5. And this is to be done before 12 months from the end of the relevant A1. And if you don't do within the 12 months or before the 12 months, then you have to pay 50%, which is from the end of the 12th month till the 24th month. So you have to pay 50% of additional tax in that situation, and interest under 234B and C shall be computed while paying these taxes. As I said, there are issues. So coming to the important point, where a notice is issued within 6 months of the end of the assessment year, and when this notice is received by any assessee, could you say that this assessment becomes now pending? That will be the most important point, because once you say that this notice is received and assessment is pending, then you straight away get ineligible for filing a updated return under 139.8A. So, and that's why I said it is unrealistic to have this word introduced by saying that whenever any assessment is pending or reassessment is pending, that becomes excluded. And more so, instead, the government should clarify and say that wherever any assessment is completed, because that gives the ability for any taxpayer to disclose or come forward, and also the intention that mentioned by the finance minister was voluntary tax compliance. So when you say that it is voluntary tax compliance, fine, if there is a assessment pending, I voluntarily come forward and filed my undisclosed or whatever was there, I have paid additional taxes. So that should have been an intention. And that's why I'm saying that it is unrealistic to apply this provision in cases where assessment is pending. Now, important point that is not clarified is once again that there is no safeguard against the penalty of prosecution. So this clarification certainly needs to come from the government in order to inspire and instill confidence on the taxpayer who's disclosing voluntarily the tax and filing under 139 8A. There was a clarification which was specifically inserted in the black money law when it was introduced, that no, there will be immunity from prosecution and penalty. Similarly, here also they should come up with this particular clarification that there will be safeguard against 270A penalty and prosecution under 276C. So this is the understanding that I have on updated return. Before I move to the faceless scheme, anybody has any questions on this particular point? All right, I'll go to the faceless scheme. Before I go to the amendments, which are quite impactful or everybody should be aware about, I will just give a basis as to why there was a need to change the provisions. As you would have seen that many writ petitions were filed because natural justice principle was denied by the government. And this writ petitions were certainly coming with a or the high courts have issued a writ there that you cannot give any unreasonable period. I'll give an example where I appeared in a case before the Bombay High Court as well as Delhi and Karnataka High Court. In Bombay High Court, we faced a situation where So we faced a situation where the assessing officer, that is the National Faceless Assessment Center, was trying to make an addition of 350 crores. And what happened is the draft assessment order was issued on Friday at around 8 p.m. And the draft show cause notice come draft assessment order said that you have to reply to us on Monday at 12 p.m. So this is absolutely unreasonable time that was given by the National Faceless Assessment Center, that one day you cannot, because Saturday, Sunday is a holiday. So you cannot expect a person to reply overnight. And second most important issue was that my all submissions that were made before the lower authorities, the previous submissions that were made before the same authority was summarily brushed aside. I gave the entire explanation as to why my business, I am earning X amount of commission, because in this particular industry, I cannot be expected to earn 15% or 20% of margins. And thus the assessing officer summarily brushed aside and he made an addition of 350 crores. So the High Court intervened and clearly gave a finding that there is a violation of natural justice principle. In fact, when the affidavit was filed by the department in this case, the department brought to the record that as I said, the notice was issued on Friday evening, and on Monday morning itself, the assessment unit had sent this to the final issuance of the final assessment order. How could this be done when the time was still pending to file the reply? And this very point, High Court came down strongly on the department, and they said that we could be they could be constrained to issue a contempt also, because this cannot be a situation where you give a unreasonable or unrealistic time of one day to the assessee to reply. And another issue that we were faced in Delhi High Court and Karnataka High Court was where it was a case of transfer pricing. And in transfer pricing cases, there is a draft assessment order generally issued. And after that, the assessee gets a time to decide whether you want to go to DRP or you want to go to the commissioner fees. So the assessee filed within the time limit before the DRP and intimated to the National Faceless Assessment Center as well as the jurisdictional officer. But to the surprise of the assessee, the final assessment order was passed by saying that the assessee never preferred any application before the DRP. So when we went to the High Court, we showed that we had filed everything. It was because of this faceless problem that the officers were not getting intimated. But yes, certainly the assessee had filed, and therefore they restored back to the file of the assessing officer once again. And they gave us the time to file the DRP also. But in that case, since we had filed, they had said specifically that this will go back to the DRP. And these were the situations where I was just making a background to explain that there was a need to, the intention of the government is very good, that you make faceless in order to remove all this bureaucracy. But it had come with a little bit of roadblocks, and these roadblocks are trying to be cleared by the department. And certainly the intention is very good on faceless. The next important amendment that is brought in this particular faceless scheme is they have moved the faceless for cases like TPO, DRP, and ITAT, and they have postponed this to 31st March because till 31st March of 2024. Because till now the ITAT, which has to be made faceless, that has to be taken in consultation with the Ministry of Law and Justice. So these guidelines and everything is still pending, and stakeholder comments are also to be taken on this account. So yes, they have postponed this. The next amendment is relating to the procedure. I will explain everyone this procedure in stepwise format because the section is quite long. You may not be able to understand everything till you make it in a very simplified manner of steps. So the faceless scheme now will say that step 1 is you have to take up the assessment for scrutiny and you issue a questionnaire. The next step is where the assessment unit receives every reply from the assessee, and after looking at the replies, they will either agree or disagree with the submissions made. In case if they agree with the submissions made and there is no variation proposed, then they will issue something which is known as income loss determination proposal, ILDP. This will be issued by the assessment unit to the NFAC, and NFAC later on will decide whether to give a review unit or not. And in another situation where they disagree with the submissions made by the assessee and they propose a variation, then they will send this to NFAC, who will in turn issue the show cause notice to the assessee, and the show cause notice will state as to why this particular addition should not be made in the assessee's case. Now, in the erstwhile regime or the present regime that is going on, there was a term used, show cause notice cum draft assessment order. Now this particular thing will not be called as draft assessment order. It will just be called as show cause notice. And the show cause notice will need to be replied by the assessee, which is the step 4. Once the show cause notice is replied by the assessee, the assessment unit, that is which will receive the reply from the NFAC, they will then decide whether to issue ILDP or not, which is the income loss determination proposal. Once this income loss determination proposal is issued, either in favor or against, that will be sent to the NFAC. NFAC will then decide in step 6 that whether the NFAC needs this ILDP to be sent to review unit or not. If ILDP is not to be sent, then they will issue the final assessment order, and if they don't agree, then they will send it to the review unit. Then review unit will respond to the NFAC on the ILDP, and on that basis the final assessment order is to be prepared. Now, coming to the issues on this particular scheme, first and foremost, there was a provision under 144B9 where they said that if any of the provisions or any of the mechanism is not followed properly, then the order will become non-est and bad in law. This particular provision has been deleted, and that is made retrospectively, because a series of writ petitions on this account is pending. So we will have to see whether high courts take this into account while adjudicating those writ petitions. More so, the welcome move is that the hearing has now become mandatory, and this procedure that is ingrained in the new scheme is going to relieve a lot of practitioners and the taxpayers while they are replying to the questionnaire or the queries from the department. The next is that e-verification, which was a problem previously while filing the submissions and all. They have now clearly said that merely logging into the e-filing portal, you can e-verify the submissions and everything. So this is the scheme on 144B, faceless scheme. Before I move to the reassessment, anybody has any questions?
No, sir.
Yeah, all right. So the next is reassessment provisions under 147. So before I start to the amendments, I'll give a understanding to the participants that no amendment has been brought in which dilutes the principles that have been laid down by Delhi High Court in Manmohan Kohli's case, or in Allahabad High Court's case, or Rajasthan High Court's case. So everyone should be relieved at least on that part, that the principles are not diluted. Having said that, the SLP against the Allahabad High Court is filed. So now it's in Supreme Court's hands whether to confirm or not on the Manmohan Kohli decision and the Allahabad High Court and Rajasthan High Court decision. So that we'll see once Supreme Court decides. But there is no amendment on this nature at all. Coming to the amendments, so presently there is a term used in 148, which is information. The definition of information is given by way of the explanation, and this pertains to reopening up to 3 years. And the explanation under 148 is going to be expanded now to include even audit objections, information that is received under DTA, then any return which is filed under 135A, and previously when I discussed in section of 14A and educational cess, that any order of tribunal or court requiring action. So this scope of information now has been widened by virtue of this particular explanation, the 4 points that have been brought in 148. And thus you may see that a lot of cases will get reopened just because of any audit objections being received or any information which is received by way of a court or a tribunal order. The second important point under 147 is widening of the 10 years cases. Previously, it was only restricted to a case where there is an asset on account of which there is an escapement of income of more than 50 lakhs. In that situation, the 10 years could get expanded. And as per the budget speech of the finance minister in last year, she had clearly said that this 10 years cases will only be reopened in serious tax evasion or fraud cases. But now it seems that the budget speech is going to be contrary to what the amendment is being proposed. So they have now put in 2 more points under 149, which is expenditure in respect of transaction or in relation to an event or occasion. And third point that they have included is entries or entry in books of accounts. This particular provision which they have inserted is very ambiguous because it becomes very wide and you could see a lot of cases getting reopened. But having said that, you should challenge if you are faced with any situation like this on 10 years on the validity of this particular provision, because certainly the budget speech that said that only serious tax evasion cases shall be reopened. If any AO takes shelter under this provision, it should certainly be challenged by way of a writ petition. I come to the next point, which is relating to section 263. This relates to revisionary powers of a commissioner, and this has now been extended to even include or by and modify the order of the transfer pricing officer under section 92 CA, and this is done retrospectively. So these amendments will certainly impact. But interestingly, I'll bring to everyone's attention that in Mumbai Tribunal, there was a case of Barclays Bank where similar situation had arisen, that as in before this amendment was proposed, what happened is the Commissioner of Income Tax, CIT, under 263 had proposed to modify the order of the TPO. And as everyone knows that transfer pricing cases, whenever there is a TP assessment, you file your TP study report, which is examined in detail by the TPO. And thereafter, whenever you go to the DRP, it is also examined by the collegium of 3 commissioners, because DRP is 3 commissioner level. And the ITAT said that when you have DRP deciding this case, which is collegium of 3 commissioners, how can a CIT now independently, who is one person, say that the order is prejudicial to the revenue? So they quashed the CIT order under 263, and they said that the DRP order is on a higher pedestal. So to overturn this particular ruling, they have brought in this particular provision, the amendment in 263. However, this could certainly be challenged as a legal question or a question of law, that a collegium of 3 commissioners as DRP, should they be on a higher pedestal as compared to a CIT, who is one person who's saying that this order is prejudicial to the revenue. So this is the second last provision. I will just quickly complete because I'm getting into another meeting. So 158 AB is the important provision that has been brought in by saying that there is a litigation management which needs to be done on account of repetitive appeals. So just to give everybody background, that there was a particular provision which was there in the statute book, but it was never utilized by the department, and they used to keep filing the appeals and everything. So now the section that is inserted, it says that identical question of law which is pending before High Court or Supreme Court, and that is similar to as in what is there in any assessee's case. In that situation, the appeal filing will be kept in abeyance till the time that High Court or jurisdictional High Court or Supreme Court does not decide the case. And this decision is going to be taken by the collegium, which is going to be 2 or more of chief commissioners or principal commissioners, and thus till that point in time, the appeal will be kept in abeyance of filing before the ITAT or jurisdictional High Court. I don't know why they have not introduced filing any SLP before the Supreme Court, because that should also have been brought in. They have only restricted this to ITAT and jurisdictional High Court. It should also have been for the Supreme Court as well. That is one point. The next is important is 155 AB subsection 4, which says that, let's take for example, if the jurisdictional High Court decides that question of law which was pending in another case in any assessee, and that was decided against the department, and the principal commissioner feels that this is not in conformity with what we understand as an interpretation or what we should be getting, then in that case the principal commissioner can still file an appeal. So I see that this provision subsection will be could be utilized by the department to its advantage by filing appeals to some extent till the time high courts don't stop them or issue any contempt or even pass strictures, because various high courts, especially Bombay High Court, have been passing strictures where department is filing repetitive appeals and it is wasting court's time. So this is 158, and if anybody has any questions, I am happy to take it. Yeah. So Pranav, you want to end the session?
Yeah, I think thank you very much, Yas. I think it was very helpful, and I think a lot of doubts were cleared. And in case anybody has any questions, we can always send it to Shreyash for clarification. And so you can send it to me. I will mail it to him or coordinate with him. Right. So thank you very much, Shreyash, for sparing your valuable time on the Saturday morning for taking this session on e-tech away from budget to 2022. Thank you very much, sir.
Thanks, Pranav. Thanks, everyone. Bye.
Thank you, sir.
Bye.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you.
ये हो गया क्या?